companies get away without paying taxes. Understanding how corporations manage to pay little to no taxes involves a close look at the ways that tax laws, corporate strategies, and international systems interplay. Many companies use a combination of legal loopholes, international tax structures, and accounting techniques to reduce their tax obligations. While there's often public outcry about large corporations paying significantly less than expected, these practices are often embedded within the tax codes themselves, designed with enough flexibility for corporations to legally minimize their tax burden. One of the main strategies corporations employ involves taking advantage of deductions and credits that are written directly into tax laws. These deductions are designed ostensibly to incentivize certain types of investments or behaviors like research and development, environmental sustainability, or job creation. However, many companies capitalize on these deductions even when the supposed benefits to the broader economy or society are minimal. For instance, tax codes may allow corporations to deduct expenses related to developing new technologies, with the idea that this will stimulate innovation and economic growth. However, some corporations may reclassify various expenses as research and development to qualify, even when those expenses may not genuinely contribute to new breakthroughs. In such cases, corporations can deduct vast sums that reduce their taxable income, often without yielding meaningful social benefits. Another significant avenue for corporate tax minimization involves manipulating depreciation and amortization. Corporations are allowed to write off the cost of assets over time, such as buildings, machinery, or intellectual property. Depreciation schedules let companies spread the deduction over many years, and in some cases, corporations can accelerate these deductions, claiming a larger portion of the asset's value in the first few years of its use. By doing so, companies reduce their taxable income sooner, sometimes to the point of generating losses on paper, even if they happen to be turning substantial profits. Amortization follows a similar principle, but applies to intangible assets like patents or trademarks. By capitalizing on these accounting practices, companies can defer or at least substantially reduce their tax bills, in effect postponing their tax obligations while still enjoying the profits that are generated by those assets. One of the most contentious issues in corporate taxation is the ability of companies to shift profits to low tax or no tax jurisdictions. This is commonly done through a technique known as transfer pricing, which involves setting prices for goods and services exchanged between subsidiaries of the same corporation located in different countries. By adjusting these internal prices, companies can shift their profits to subsidiaries in countries with lower tax rates. For example, a corporation headquartered in a high-tax country might set a high price on goods sold by a subsidiary in a low-tax country, transferring the bulk of its profits to the low-tax jurisdiction where it faces a smaller tax bill. This process can be further complicated by companies setting up shell subsidiaries and tax havens, places with very low or zero corporate tax rates, and often limited financial reporting requirements. These shell companies may have few employees or actual operations, yet they serve as conduits through which corporations funnel profits, effectively lowering their overall tax liability. Intellectual property or IP rights offer yet another pathway for corporations to reduce their tax obligations. Corporations can establish subsidiaries in low-tax countries that own the patents, trademarks, and other forms of IP that generate significant revenue. The corporation then pays royalties or licensing fees to these subsidiaries, deducting these payments as expenses in higher tax jurisdictions. In essence, by setting up these royalty payments, the corporation reduces its profits in the higher tax country and shifts those profits to a lower tax jurisdiction, even though the corporation may still be entirely based elsewhere. This technique is commonly seen in industries heavily reliant on patents and IP, like pharmaceuticals and tech, where patents are central to the business model and are relatively easy to transfer across borders. Another area where corporations reduce their tax burden is through tax credits tied to losses. Tax loss carry-forwards and carrybacks are provisions that allow corporations to apply a net operating loss to future or past tax returns. This practice benefits corporations by enabling them to offset profits with losses from previous years, significantly reducing their tax liability in profitable years. For example, if a corporation incurs large losses during an economic downturn, it can carry forward these losses to offset profits in future years. This approach allows companies to stabilize their tax burden over time, but it also means that corporations with consistently high profits may still pay minimal taxes by leveraging past losses. Certain corporations also benefit from deferral provisions, particularly when it comes to foreign profits. Under some tax systems, corporations aren't required to pay taxes on foreign profits until those profits are repatriated to the company's home country. This provision enables companies to indefinitely defer taxes on profits made abroad, often by reinvesting those profits in foreign markets or holding them in foreign subsidiaries. The deferral can continue as long as the profits remain offshore, effectively allowing corporations to avoid home country taxation. Though some countries have attempted to close this loophole by implementing a minimum tax on global income, many corporations continue to benefit from deferral by using complex organizational structures that obscure the movement of profits across borders. These techniques are further bolstered by extensive lobbying efforts that ensure favorable tax policies remain in place or even expand. Large corporations have the resources to influence policymakers and push for complex tax rules that benefit them, often arguing that lowering corporate taxes will spur job creation and economic growth. As a result, many tax laws are structured with enough complexity that they leave room for interpretation. gaps or inconsistencies. This complexity means that even if a law is intended to prevent certain tax avoidance strategies, corporations may identify ambiguities or technicalities that allow them to sidestep those restrictions. Smaller businesses and individuals like you and me simply don't have the resources to navigate or exploit the system in the same way. But for large corporations, this complexity effectively becomes an asset, a tool for minimizing tax liability. One of the more recent trends in corporate tax avoidance involves using financial engineering and complex debt arrangements. Corporations sometimes take on substantial debt, which allows them to deduct interest payments as business expenses. In certain cases, companies create internal loans between subsidiaries to maximize these deductions. For example, a subsidiary in a low-tax jurisdiction might lend money to a subsidiary in a high-tax jurisdiction, allowing the borrower to deduct the interest payments from its taxable income. The lender, meanwhile, may face a minimal tax burden on the interest income, especially if it's located in a low-tax country. This internal debt strategy can significantly reduce a corporation's overall tax bill by reclassifying profits as deductible expenses. In some cases, these arrangements have been criticized as artificially inflating debt to minimize taxes, even when the loans have no economic purpose other than tax reduction. Another area where corporations gain a tax advantage is through stock options and executive compensation. Many corporations provide stock options to executives as a form of compensation, and these options can be deducted as business expenses, even though they're a non-cash cost to the company. While this deduction is meant to align executive pay with performance, and in my opinion rightfully so, in practice it often creates large tax deductions that reduce corporate tax bills, even as executives realize substantial gains from the options. In some cases, companies can even adjust the timing of when stock options are granted or exercised to maximize tax benefits, creating an added layer of tax some countries.